family cottage, keeping the history, memories, and ownership in the family. I'm Peter Waters, here to talk to you about a common sentiment with clients. My family loves the family cottage. One day it will be theirs. But how will it be done? A gift, a sale, or simply putting their name on title? If your clients intend for their children to own the family vacation property one day, beware. It may cost many times more what they originally paid for the property to transfer it into their hands years down the road. Underestimating the tax impact is a big error that parents make when transferring the family vacation property to their children. There are a number of issues, a number of options, and emotions involved in the transfer of a family vacation property, particularly one that has been held in the family for decades and has been enjoyed by multiple generations. Underestimating the tax impact is a big one. Where will your money get the money to pay for it? Stemming from that is the strategy of declaring your vacation property as your principal residence. How does that work? This session will cover these topics, providing issues, emotions, and options on keeping the history, the memories, and the ownership in the family on a transfer to succeeding generations. Now, talking about the cottage, there are many variations of that. Some are very expensive, some are just a cabin. Perhaps it's a resort style. Perhaps it's a chalet, a condo, or a full-fledged year-round home. The property may be located in Canada. Then again, what about the vacation spot in the southern United States, or the chalet in Vermont, or New York, Utah, or Washington State? A tax liability is triggered on actual or deemed transfer to kids while your clients are alive. The tax liability on death must be paid by their estate before their kids or other heirs can receive the cottage. Liquidity is required to preserve this valued asset. If their estate does not have sufficient assets, it may be forced to sell the cottage to pay the tax. This means the family cottage would not stay in the family. This is a tax time bomb that many people are simply unaware of or grossly underestimate. Again, that tax liability is triggered on the actual or deemed transfer to kids while your clients are even alive. The tax liability of death must be paid before the transfer to the kids if the transfer is done at death. Liquidity, of course, is required to preserve that valued assets, and the estate needed to sell a cottage in order to pay that tax. Let's look at the capital gains rules and exactly how they work. A taxable disposition occurs at death or when the property is gifted or sold. 50% of the growth since 1971 or a later acquisition of the property must be taken into income upon disposition. A large gain could be triggered and it will be taxed perhaps at the highest marginal tax rate. Taxes may be paid for as long as a 5-year period, but interest will be applied and security must be provided. Proper planning allows the capital gains to be postponed until the later death of two spouses. Now, before 1982, couples could each declare one property as a principal residence. One could claim the home, the other the cottage. And you may still be able to get a capital gains exemption on that period of time to 1971 and 1982. I've got a question already, and it has to do with losses on a vacation property. But losses on vacation properties cannot be offset against other capital gains, say on an investment portfolio. Vacation properties are classified as personal use properties, and losses are deemed to be nil. Real estate booms have triggered significant increases in the value of vacation properties. And when coupled with improvements, the total value today is generally far more than the original purchase price. So this is a tax time bomb in terms of capital gains liabilities. How does it work exactly? Here's an example. The initial purchase price of a cottage is $100,000. The cost of additions in this example, $50,000. Let's say that the individual was astute enough to actually take the 1994 capital gains election. Prior to 1994, there was a capital gains election that was available to individuals. It was equal to up to $100,000. So that meant the adjusted cost base as of 1994 would have been $250,000. 40 years later, at a 6% annual growth rate, that cottage is now worth over $1.5 million. When you subtract the adjusted cost base from the property, it means the capital gain right now is almost $1.3 million. half of that is taxable, or $646,000, and the income tax payable, even at a 45% tax bracket, would be $291,000. And we know there are jurisdictions with a tax bracket for that amount of money added to your other income is going to be more than 45%. Remember that the tax hit would increase if the capital gains inclusion rate is increased, or the tax bracket is higher, or you're in a jurisdiction where tax rates for that type of income are also higher. Let's look at gifting vacation property. Ask yourself these questions and get your clients to answer these questions for you. Can your clients afford the gift? Can their estate afford the bequest? Or must the family cottage be sold to pay the tax? Now let's assume the existing ownership structure of that vacation property has been set up with the parents on a joint and last survivor basis. In other words, the parents own it jointly, and it will continue to be owned by the surviving parent until that surviving parent passes away. Now let's consider what would happen if there was a gift of that property to a succeeding generation or a sale. If they sell the property to a child, then there's no protection from the division of family property if the child is married, or a common law depending on the jurisdiction. In fact, a gift or a sale have the same consequences to the parents in terms of taxes. They are deemed to have received fair market value for that property. But that's not the case for the child. If the sale is at a nominal price, then this becomes the adjusted cost base for the child, and they could face double taxation. How? The parent pays capital gains tax on the original increase from the adjusted cost base because they're deemed to have sold it at fair market value. The child pays capital gains on the difference to fair market value on the original sale to the child plus the future growth in value. In other words, if the child pays a nominal price, that becomes that person's adjusted cost base, and then their gain is measured from that point in time. You can see that could be a double taxation type of situation, getting taxed on the same part of the same growth by two succeeding owners. Clients should look at gifting if they're feeling really benevolent or the child simply cannot afford fair market value. A mortgage or a promissory note can be forgiven later in life of the parent, or perhaps even as a testamentary gift. But take care in charging and collecting interest on the note or mortgage to make sure this is a bona fide arrangement that stands up to the scrutiny of the Canada Revenue Agency. And there are no negative tax consequences in engaging in this type of a strategy. The clients could sell the cottage to the kids now. By selling the cottage to their children now, they effectively cap their tax liability and pass the responsibility for any future capital gains to them. Keep in mind that capital gains are triggered at the point of sale and must be paid to the government. Alternatively, a transfer of ownership to a child or to children triggers the same capital gain with the growth attributed to the children, but this avoids divisible property rules on marriage breakdown. Favorable payment terms can be arranged, a low or no interest mortgage, and perhaps even testamentary forgiveness. And the parent's capital gain can potentially be spread over 5 years. A lot of people are bothered by probate and estate settlement costs, just the idea of having to pay them, and are interested in ideas of how property, like the family cottage, can be transferred outside of their estate and to avoid probate or estate administration fees where applicable. For business owners in particular, transferring the cottage outside of the estate may also avoid any potential claims against their estate by creditors or other interested parties. The children get to enjoy it now and experience both the pride of ownership and responsibility for upkeep, including taxes and utilities. The clients are assured that the cottage stays in the family, and the tax impact of the transfer, of course, will vary depending on the consideration paid for that property. What price do you set for the kids now? The proceeds of disposition, the actual sale price, in an arm's length sale or transfer is used in the calculation of capital gains. However, if it's gifted or sold to children for less than fair market value, the Canada Revenue Agency still deems the transfer to occur at fair market value, whether it's done during lifetime or as a testamentary gift, since this is deemed to be a non-arm's length transaction. If sold, the adjusted cost base for the child is the amount paid. This produces a double taxation situation for the difference between the selling price of the child and the fair market value for the parent. The child disposes of it or is deemed to dispose of that property down the road. Gifting at death may be better than selling for $1 during lifetime. If parents want to transfer or sell a vacation property at less than fair market value to their children, then consider selling at fair market value and taking back a promissory note with no interest. This sets a higher cost base for the children down the road, and it reduces their payment obligations. If the cottage is transferred to one of several children, then at death, the outstanding loan reduces the share of the estate for the child with the vacation property. That's how you divide up a property or an estate where the vacation property goes to one or two children, and there's other assets that go to other children or other heirs. If there's a debt or a promissory note or mortgage, and that's to be forgiven at death, then ensure that the will states this. Forgiving the debt before death will trigger a negative consequence. Ensure the parent structures the promissory note with vacation property and others as security in case the child has creditor problems, so that the parent ranks above other creditors and in case the child cannot keep up the loan payments. If the cottage is sold for more than fair market value, and that can happen in a situation perhaps because parents need some extra money, the children are quite affluent, well, in that situation, the proceeds of disposition will set the value up for the capital gains liability to the parent, greater than fair market value. However, since this is a non-arm's length transaction, the Canada Revenue Agency will deem the sale to the child to be at fair market value for the child, and the growth from there, not the purchase price, will be taxed as a capital gain. This again produces a double taxation situation for the difference between the selling price of the child and the fair market value for the parent when the child disposes of or is deemed to dispose of the property. So to decrease the impact of capital gains, remember that the cost of the property includes renovations, improvements, but of course not regular maintenance. So the cost is typically more than the purchase price, but you have to keep records in order to prove that these numbers, these values, are going to be more than the original purchase price of the property. Now, when you do sell the cottage to their children and to the kids now, the cottage goes to the kids outside the estate. They get to enjoy it now and experience pride of ownership. You're assured it stays in the family. You can avoid probate and estate creditor claims, but the tax impact, of course, can vary depending on consideration given for the cottage. Again, when you set the price for the kids right now, the tax liability is fixed for your clients, and the Canada Revenue Agency will treat the transfer at fair market value regardless of the actual price sold or whether or not it's given away. So there are going to be implications of selling at less or greater than fair market value, as I've just mentioned. And you could be in a situation where your clients could face double taxation down the road. And that's, of course, where you can step in with some recommendations on either them seeking some outside legal counsel to restructure their affairs or coming up with some liquid dollars that can take care of that problem. The clients could sell the cottage to the kids now. And the proceeds, of course, can serve as an income source to the parents. Maintaining the cottage time is time-consuming, it's expensive, the cost of upkeep can be redirected to other things, and the proceeds can supplement retirement savings or lifestyles for the parents. It can pay for that dream vacation or perhaps allow their parents to retire earlier or more comfortably. Let's look at the transfer ownership type of structures. Parents could jointly own the property with their children. They could enter into a joint ownership structure with their children, which also triggers capital gains for the portion that's transferred. And remember, the portion transferred will be transferred at fair market value. By doing that, the parents can retain some measure of control and share in the upkeep responsibilities, the taxes, but the property can now be exposed as well to creditor and or family problems of the children, including marital claims. So this could actually backfire. There are other problems with ownership transfer to the kids as well. A change in registered ownership triggers accrued capital gains liability, again, on the fair market value of the property. But what about moves to subsequent generations? Because each one of those will trigger a calculation on capital gains to see if there is any. Of course, capital losses are not taken into account because it is personal use property. When you're looking at how you own property, one of the questions is, well, jointly owned, what does that actually mean? If you owned your property as tenants in common, then interest is held by each party, and each party's interest goes into their respective estate, which is subject to probate multiple times since there are going to be multiple owners. Joint tenancy with rights of survivorship means that the interest of each party goes to the survivor outside of the estate. Each joint owner has an undivided interest in the entire property. And with siblings, the deceased family is left with a tax bill since this is a deemed disposition. The property could pass to siblings, not immediate family. Is that the intention? Each subsequent transfer, again, is a deemed disposition, triggering a capital gains calculation. Other problems to consider include proving true intention of the parent in transferring a property to joint ownership with a child. What if it's to one child of several? Is it a true gift, or is it a probate avoidance strategy and an estate planning scheme? That type of a strategy, that type of a scheme could face challenges by creditors, probate courts, and the other beneficiaries. The probate estate settlement issue may be dwarfed by those other issues. Who's going to cover the ongoing maintenance on jointly owned property? How do you manage or mediate operating expenses, access, future development, and a subsequent sale of an interest in the cottage? Is this all documented? And if it was the parent covering all of this, was that a series of future gifts? Here comes another question. How do you prove it was a gift? Well, my question is it documented? You see, there's a presumption of resulting trust, and that means that the surviving joint owner may have to prove that the true gift was actually intended and defend against an alleged conflict of interest and self-serving, perhaps dragging the property back into the estate for division of property. Again, you may avoid these issues by engaging proper legal advice and counsel and completing a declaration of intention for joint assets. There are, of course, other transfer options. Let's look at a couple. You could transfer the property to a corporation, but transferring a property to a corporation will trigger shareholder benefit charges for the value of the received usage according to the Canada Revenue Agency. So if you had rented it out at fair market value, what would that cost? What would that cost? And in that type of situation, that could be the deemed taxable benefit to you, the user of that property. Your clients will lose the principal residence exemption opportunities. The transfer into the corporation triggers a capital gain on the transfer if the property has appreciated in value. And of course, a transfer either way triggers income tax on unrealized capital gains. You could consider transferring the property to a family trust, again at fair market value, but that would trigger a capital gain. There are exceptions to triggering income tax on the rollover to a trust, including a spousal trust, an alter ego trust, and a joint partner trust. But when you transfer things to a typical family trust, there is that 21-year rule you have to consider regarding a deemed disposition and a cash flow issues, especially in a rising real estate environment, and the timing of that. You do, however, have better long-term control. You can have certain types of inclusions and classes of beneficiary. You can get pretty fancy in terms of how you want to control this, who's going to get it, who's entitled to it, and under what circumstances. And setting it up properly, you can roll it out at the adjusted cost base to beneficiaries. The beneficiaries could, in a family trust, claim the principal residence exemption. And of course, it's easier if you're purchasing the vacation property via the trust as opposed to transferring a property to a trust, or the property has a loss or small accrued capital gain, so you're minimizing the capital gains hit on the transfer to the trust when you're employing that strategy. Again, let's look at the exceptions to triggering income tax on a rollover to a trust, which of course include a spousal trust, an alter ego trust, or joint partner trusts. Take care with a spousal trust. To be a qualifying spousal trust, the property must vest indefeasibly in the trust within 36 months of the death of an individual. All of the income of the trust must be paid or payable to the spouse beneficiary during their lifetime. The spouse beneficiary must be the only person with the right to the use and enjoyment of the property during their lifetime, and that can be a little constricting. A trust can allow for some flexibility in administering the property, letting your clients, who may now be grandparents, pass some responsibility to their children and grandchildren without giving up all rights to use the cottage or even to earn income from it. No one other than the grandparents, your clients, may receive or make use of the income or capital of the trust before the later of their deaths. This is important because a failure to meet this requirement would adversely affect the tax-free rollover of the cottage to, again, that alter ego trust, that joint partner trust, or that spousal trust. Transferring a property to one of these three personal use trusts mentioned can defer capital gains taxes and keep the property outside of the parent's estate on death, reducing probate and estate settlement fees. And of course, it ensures privacy. For example, a joint partner trust could name the grandparents' children as contingent beneficiaries of the trust. When both grandparents are deceased, the trust would distribute the cottage to the children. Another option may be to review housing arrangements and considering the possibility of using the cottage and claiming the cottage as a principal residence. For example, parents may have downsized to a condominium in town, spending much of their time at the cottage. The cottage could be reclassified as their principal residence, and capital gains problems down the road transferred to their condominium, which may not incur the same type of growth in value. You are now required to report every disposition of a principal residence on your personal tax return. It doesn't matter if the gain is fully sheltered from income tax or not by that principal residence exemption. Up until the 2016 taxation year, the Canada Revenue Agency did not require you to report the sale of a principal residence if the gain was fully sheltered by the exemption. Effective with the 2016 taxation year, if you don't report the sale on your income tax return, the property disposition will be subject to an open-ended reassessment period. Now, the normal reassessment period for an individual taxpayer is generally 3 years from the date of the initial notice of assessment. The question that's come up just now is, what does open-ended assessment period mean? Well, the open-ended assessment period means that an extended period of time has been added outside of that normal 3-year reassessment period for any tax year where the taxpayer, 1, does not report the disposition of the property in the year on their tax return, or 2, does not file a tax return for the year in which he or she sold the property. If the Canada Revenue Agency assesses income tax on that property disposition, then the 3-year limit does not apply. If the principal residence designation is filed late, penalties will be payable. Clients, again, could be tired of the cottage. They could sell their home and declare their vacation property as their new principal residence. They must own that property alone or jointly. They must live in that property in any given year, a minimal amount of time. It doesn't have to be a great deal of time. A family unit can only designate, of course, one property as a principal residence for a given year. The property size can be up to a hectare. That qualifies as part of the principal residence. More can be included if necessary for the use and enjoyment as a residence. And of course, in order to claim this as a principal residence, you need to be a Canadian resident. Question just comes up. Does the vacation property have to be located in Canada in order to claim it as a principal residence? And that's a great question. A principal residence for Canadian income tax purposes can be anywhere in the world. And I would refer you to the Principal Residence Outside Canada folio that's put out by the Canada Revenue Agency. Again, folio S1F3C2. You can send me an email. I can send that off to you. Basically, just Google Principal Residence Outside Canada, and you can use that property as your principal residence and make an appropriate claim. Again, though, note the difference between principal residence for capital gains purposes and treatment and residency for income tax purposes. Jurisdictional claims if you're deemed to be a resident now of another country. So watch foreign taxes due or triggered. You may get a foreign tax credit. Here's another question. What about declaring a rental property as your client's principal residence? Well, the answer to that is pretty simple. Rental properties cannot be classified as a principal residence even though owners stay there for a certain period of time. There is, however, a special 4-year exception rule before or after the entire property is used as a principal residence when the property can be designated as a principal residence and no other home is claimed. And a special election is filed when renting out that property. This allows the capital gain to be deferred and tax paid only when the property is eventually sold. This election also allows a taxpayer to treat the property as his or her principal residence for up to 4 years before it is actually occupied as his or her principal residence. The taxpayer's ownership of the property qualifies for purposes of Section 54 of the Income Tax Act of Canada definition of principal residence, whether such ownership is held jointly with another person or otherwise. A designation as a principal residence is only made when a property is sold and is based on one of 3 options. 1. The property is designated as a principal residence for all years of ownership. The entire gain on the sale is tax-free. The second scenario, the property is not designated as a principal residence for any years of ownership. In that case, the entire gain is subject to tax. 3, the property is designated as a principal residence for some but not all years of ownership. In that situation, part of the gain on sale is subject to tax. The question that just comes up is, well, what happens if the sale or deemed sale results in a loss in value? A property which is used primarily as a residence for the personal use and enjoyment of those living in it, or an option to acquire a property which would, if acquired, be used for personal use and enjoyment of those living in it, is classified as personal use property. That means if there is a loss in value realized on the disposition of such a property or an option to buy it, the loss is deemed to be zero. And that's covered off in our subparagraph 42G3 of the Income Tax Act of Canada. Now let's look at that third option, designating the cottage as a principal residence for some but not all years of ownership. As you can see on the slide, the capital gain, but not the loss, can be reduced as follows. The reduced capital gain is calculated according to the formula A times B divided by C, where A is the capital gain, B is 1 times the number of years the cottage was a principal residence and the owner was a Canadian resident, divided by C, the number of taxation years ending after December 31st, 1971, or when the cottage was acquired, if it was acquired at a later date, during which the property was owned by the family unit. Let's look at an example. A homeowner purchases a cottage in 1995, after the personal capital gains exemption is gone. The client sells his home in 2005 and then designates the cottage as his principal residence. The client passes away in 2025 when the capital gain on the property is $500,000. What is the effect of the principal residence exemption? Well, again, the capital gain, you take the capital gain, which in this case would be $500,000, and you multiply it by 1 times the number of tax years the home was a principal residence, divided by the number of tax years the home was owned. So the capital gain from the previous slide was $500,000. It's 1 times 21. Again, you count every taxation year. Normally in the math, you'd say, well, 2025 subtracted from 2005 is only 20, but that is 21 taxation years, not 20. And so when you do that formula, you come up with $354,838.70. And you divide that by 31, which is the number of years that the cottage was actually owned. So then you come up with a number of $145,161. That becomes the reduced capital gain. So instead of $500,000, it's now $145,000. Remember, of course, that 50% of the capital gain is taxable, and the actual tax will vary between 40 and 50%, or perhaps even a little bit more, depending on the province. That 1+ factor sometimes throws people off. It applies only where the taxpayer is a resident in Canada during the year in which they acquire the property for dispositions that occur after October 3rd, 2016. For the 2016 taxation year, Form 2091, which is the designation of a property as a principal residence by an individual other than a personal trust, only had to be filed if your home was not your principal residence for the whole time that you owned it. This form required the input of the proceeds, the adjusted cost base, any outlays and expenses related to the sale, and other information required to calculate the capital gain. For 2017 and later taxation years, either that form, the designation of a property as a principal residence by an individual other than a personal trust, or must be filed for all principal residence disposals as indicated on Schedule 3. If your home was your principal residence for the whole time that you owned it, only page 1 of the T2091 form, that designation of a property as a principal residence by an individual other than a personal trust, has to be completed. Only page 1, not the pages where the proceeds and the adjusted cost base are actually reported. Here's another question. Does the type of ownership structure affect the principal residence exemption? Well, the definition of principal residence under Section 54 of the Income Tax Act of Canada requires that the taxpayer own the property jointly with another person or otherwise. This includes sole ownership, joint tenancy, tenancy in common, and co-ownership. Watch provincial laws for determining the ownership of the property. Example, laws relating to marital property. If there is more than one owner, each will report the sale on Schedule 3 and that T2091 form, using only their share of the proceeds and cost base when this information is required. For instance, when a home is owned jointly by a couple and each owns 50%, each will report 50% of the proceeds on Schedule 3 or that T2091, depending on the taxation year and depending on whether this information is required. And again, what happens if you don't file that? That's the next question. Well, there is a penalty of up to $8,000 filing penalty. If you fail to report the sale of your principal residence at all, you may be taxed on the capital gain. And of course, you don't want to be in that type of a situation. Again, looking at that example here, and I think it's really important to note, the capital gain initially looked like it was going to be $500,000, but it was now reduced to $145,000. Ensure that when you're looking at the problem with a client and you're looking at recommending a solution, that you're focusing on the right numbers. A taxable gain inflates the total income. The tax payable is the extra cash needed to cover that liability alone. I wrote a piece called Case in Point on using the lake property and declaring the lake property as new principal residence with these formula. You can access it on the Empire Life website, advisor section under business building. Now, what are the possible solutions at death? Well, the estate or the children could pay the income tax liability from current funds. The question is, are funds available? Unfortunately, to preserve as much of the estate as possible, liquidation may force clients to sell their most prized assets to protect the rest. Only they will command the highest price when cash is needed fast. You generally have two categories of assets that I tell the clients all the time. You've got jewels and junk. You think you can sell your junk, but you're lucky if you can sell your jewels, and you'll sell your jewels at junk prices. If the intent is to keep the cottage in the family, does the will even give explicit instructions as to which assets are to be sold to pay those tax liabilities? Capital gains, income taxes on registered funds, estate settlement costs, accrued debt on reverse mortgages, unpaid medical expenses, funeral costs. Where is the money going to come from to pay for all of this? Money could be borrowed to pay the tax. But the questions are, would credit be readily available? Would the borrowers have adequate cash flow to repay the loan with interest? What would the non-deductible interest rates actually be in that type of a scenario? Money could be paid in installments after death. Would the estate or children be able to provide the necessary security to the government? Would the estate or heirs have adequate cash flow to repay the amount owing with interest? And what would that interest rate be? Here's some assumptions. Let's look at a cottage that was purchased for $50,000 way back when, where the annual average growth rate is 6%. The tax rate when the cottage is transferred is 45%. And the 1994 capital gains election was not claimed on the cottage. This is a chart that shows the growing income tax liability of that property. 10 years down the road, the gross value of that property would be $90,000. The capital gain would be $40,000. Remember, the original purchase price was $50,000. The taxable capital gain would be $20,000, and the tax payable at 45%, $9,000. 20 years down the road, the gross value would be $160,000. The capital gain, $110,000. The taxable capital gain, $55,000, which, by the way, now is more than the property was actually worth 20 years earlier. And the tax payable, $24,750. 30 years down the road, that gross value has jumped to $287,000. The capital gain is $237,000. The taxable capital gain, more than double the price of the cottage when you first bought it, $118,500. In fact, the tax payable is more than the purchase price of the cottage. 40 years down the road, again, reading across, the tax liability now jumps to $232,000. That's the taxable gain. The tax payable, $104,000 on that number. And 50 years down the road, this cottage had been bought by parents or grandparents within their late 20s, early 30s, and they held on to it until their 80s when they passed away. The gross value at 6% alone, $921,000, if that's the rate to grow at. The capital gain would be $871,000. The taxable capital gain, $435,500, and the tax payable, $195,000. Again, ensure that the problem and the solution focuses on the right column. And the column you really want to focus on is that right-hand column. The taxable gain inflates total income. That's why that's important to know. The tax payable is the extra cash needed to cover that liability alone. Again, remember that the tax hit would increase if the capital gains inclusion rate is increased and or the tax bracket is higher than stated in this particular example. Now, what about vacation properties in the United States? Well, in that type of a situation, there could be potential federal and state estate taxes on the value of the property, not the capital gain. And there's a difference between Canada and the United States. Canada, of course, does not have estate taxes. The United States has both estate taxes and income taxes. But on death, the value of the vacation property, not the increase in value, would be taxed in the United States, and only the increase in value would be taxed in Canada. So there is that potential for double taxation because an estate tax is not the same as a capital gains tax. There is a U.S. estate exemption if your U.S. assets are worth up to $60,000 in U.S. dollars. There is, and you've probably heard about this, the worldwide assets of up to $11.4 million may also avoid the tax. However, unless you're an American citizen, that really isn't going to apply. Canadian residents get proportional access as a result of the Canada-U.S. tax treaty. And so the proportion that they get would be related to the U.S. situs assets divided by their worldwide assets. So that could actually be a pretty small fraction of the $11.4 million that they actually get. And you need to file a U.S. return regardless if the U.S. situs property is equal to $60,000 U.S. or more. So if it's worth more than $60,000 U.S. or more on death or sale, you must file a U.S. return. On death, if this happens on death, the executor is liable to file this form. It's a criminal offense for not filing it, and there will be penalties for failure to file. Now remember that 16 states have independent estate and or inheritance taxes, and any break you're going to get on estate taxes on your Canadian income tax return are going to be federal only. And if 16 states have independent estate or inheritance taxes, there is no treaty between those Canadian provinces or the federal government and the U.S. estate taxes in those particular states. So there would be double taxation if that property has increased in value. Now let's step back for a minute and consider a complicating factor. Your clients have a U.S. vacation property which they rent out part of the time. Well, Canadians are subject to 30% withholding tax on gross rental income. Now clients have expenses, they'll probably want to elect the net rental income method, a permanent election that applies to all U.S. rental real estate. They can get a waiver from withholding by providing the tenant or agent with a special form. It's a W-8EC1 every 3 years. So there is some paperwork involved in doing this. They must file a tax return annually, and you'll need an individual taxpayer's identification number, which you can get by filing another form, a W-7, with the IRS to apply for that individual taxpayer identification number. The kicker from a tax planning perspective is that they must claim depreciation if the property they own is not strictly for personal use, and this is not a discretionary amount. This reduces the property's cost base and increases the amount that's going to be subject to tax on disposition. So here are some questions about Canadians with homes in the United States. Typical questions that I hear all the time. How do I purchase or own my Florida or Arizona or U.S. property? Do I own it personally? Do I own it with my spouse? Or do I own it with my children? Do I use a company? A Canadian company? A U.S. company? A U.S. LLC, which is a limited liability company? Do I use a partnership? Do I use a trust? A complex trust? A revocable trust? A land trust or a bear trust? Well, information and answers to these questions are beyond the scope of today's session. Clients need to deal with a lawyer well-versed in cross-border tax and property planning to get this right so that the structure minimizes tax and legal consequences in both countries. How might your clients avoid or defer U.S. taxes on vacation property? Well, joint ownership is certainly an option, but the joint ownership should not be as joint tenants with rights of survivorship, but as tenants in common to optimize flexibility in minimizing estate taxes, which means you might have to unwind the original deed and set it up as tenants in common. Both parties, both spouses or common law partners, must contribute to the purchase price in order to avoid taxation on the first death for the entire amount. You can use annual gifting for spouses to systematically transfer equal ownership of U.S. property from a contributing spouse or majority owner under U.S. law to a minority contributor spouse, up to $155,000 per year to a non-U.S. spouse as of 2019. And that means redeeding the property each year. That, of course, triggers Canadian disposition tax in the form of capital gains. But the survivor gets a bump in the adjusted cost base for Canadian tax, and the decedent gets a bump in the estate tax exemption, since the United States and worldwide estate value are reduced. You could look at a non-recourse mortgage, which yields dollar-for-dollar reduction against the value of real property included in the estate. The maximum non-recourse mortgage typically is 60% of the equity or value of the property home. It's becoming easier to obtain again after that market turmoil that we all went through in 2007, 8, 9, and 10. You need to use an arm's length financial institution as a lender versus a family loan. Again, consider the income tax issues on the interest part of the payments. The interest paid may be deductible in Canada if it's reinvested in accordance with Canada Revenue Agency guidelines. If you haven't bought a U.S. property, then the pair could set up a trust and fund it with cash from the trust. The spouse could be a trustee, not a settlor. The trust is a taxpayer in the United States and Canada and the owner of the property. The trust beneficiaries can pay the rent and the expenses, but no living beneficiary can contribute to the trust so as to avoid proportionate interest classification for U.S. estate taxes. Capital improvements come from the settlor or the grantor. Taxable events would be synchronized for Canada and the United States for foreign tax credits. On the sale of a property, you can take the proceeds and buy a new place. And on the death of the spouse trustee, the settler spouse must pay rent to use the property to avoid tax challenges. This avoids a shareholder benefit issue with especially corporate-owned property. Now let's consider the family cottage as a matrimonial property in the instances of breakdowns. I don't have a lot of time to go through that this afternoon, but I did write 2 articles. One, dealing with the cottage where it's included as a matrimonial home, and 2, is the second home always a matrimonial home? Some good information in this. Again, you can get it by going to the advisor site of the Empire Life website under business building, look under case in point, and Google down for these 2 articles. Let's consider a cottage legacy builder, an opportunity that you have to provide liquid solutions, especially in the event of the passing of the owner of a vacation property, where the intent is to pass it down or perhaps sell it, but deal with the tax consequences. Here's some possible solutions. You can use appropriately designed life insurance to pay the taxes. Income tax liabilities, of course, arise on death, and life insurance creates immediate tax-free cash to provide a solution. Joint second death protection provides a very economical way to provide cash to the estate if the intention is to keep it in the hands of the parents or the original owners until they both pass away. Many life insurance plans are suitable for paying the estate's income tax, are available at premiums of 1 to 5% or less of the sum insured. So for every dollar you're looking at paying in tax liabilities, it may cost you between 1 and 5% of that, or a penny to 5 pennies each year to pay for that. And it can be custom designed to handle your needs and values. One of the questions that comes up is, well, who should own a cottage legacy builder? Well, why not have the children own it and have them pay for it? When it matures or it's paid out when both parents have passed away, the children then have the money and can use it to pay off any capital gains and associated costs of keeping that family cottage and property in the family. It can also be used to equalize inheritances if the cottage is not shared among siblings. Let's look at an example. John and Mary Cottager. He's 65, she's 62, they're both non-smokers. The single equivalent age is a male, age 55, non-smoker. And they're looking at a $250,000 permanent life insurance policy. The coverage type we're looking for this particular example is Estate Max. In terms of level deposits, they'd be looking at 2.1% a year. So at 65 and 62, 2.1% a year of $250,000 doesn't seem like a lot of money. If they decide that they want to have this completely paid up at average life expectancy, and again, that measures the point in time at which half the population passes away. So by the time they get to 85, and perhaps they're looking now at long-term care or assisted living, and they don't want to have this responsibility anymore, they perhaps want to redirect that money to assisted living costs, then in 20 years, by making annual payments of about $6,800 or 2.7% of the problem, they can have this taken care of. Question is, which choice do you prefer? Paying 2.1% a year or 2.7% a year? A cottage legacy builder really is an insurance policy, the best kind of insurance to keep the history, the memories, and the dreams in the family. It's efficient, tax-free, and inexpensive when you compare it to all the other alternatives. And it certainly provides peace of mind for all. Peace of mind for the parents, peace of mind for the people assuming the cottage, and peace of mind for those people that aren't participating in the cottage transfer and are looking at getting their share, equivalent share in terms of value from the property. And insurance, of course, can provide that equalization of the estate. There is that common sentiment, my family loves the family cottage. One day, it will be theirs. Well, how will it be done? Will it be done through a gift, a sale, or simply putting their name on the title? If your clients intend for their children to own the family vacation property one day, they should beware. As you have learned, there may not just be the mushrooming capital gains liability, there are a number of issues, a number of options, and emotions that are involved in a transfer of family vacation property, particularly one that has been held in the family for decades and has been enjoyed by multiple generations. Underestimating the tax impact is a big one. Where will the children get the money to pay for it? Stemming from that is the interim strategy of declaring that vacation property as the principal residence and how that works. This session has covered a number of issues, options, and solutions dealing with keeping the history, memories, and ownership of vacation property in the family when considering a transfer to succeeding generations. So let the conversations begin. Consider what options may work best for your client's particular situation, and get working on implementing a plan that keeps their sentiment alive.